Welcome everyone to today's webinar on navigating President Biden's new tax legislation in 2021 and beyond. I'm Mitch Gerstein. I'm going to be today's moderator. Unfortunately, Scott Isdaner, our managing partner and planned moderator, unfortunately is unable to join us today. He is okay, but I'm going to fill the reins and the show must go on. So with that, I'd like to start with introductions of our panelists. Next. So again, I'll be the moderator today, Mitch Gerstein, and I'm Senior Tax Advisor at Isdaner. I want to introduce you to some of our panelists that are going to be speaking on some of the relevant topics. And with that, I'd like to introduce first John Campbell, who is a manager in our tax department. We'll also hear from Jim Marota, who also is a manager in our tax department. Rebecca Norris, manager in our tax department, and Amy Stumhofer, who is a director in our integrated services department. Next. So, today I wanted to go over a couple of housekeeping items. Please enter your questions in the Q&A box at the bottom. We will do our best to get to them at the end. As you're seeing right now, these are the topics that we will be doing, speaking about the panelists through a lightning round of discussions. And just wanted to back up a little bit before we jump into these topics to talk about how the early on the Biden proposals had many harsh tax proposals items, and that most of them have been removed from the final proposal, including the increase in individual ordinary income tax rate, the expected increase in the capital gains and dividend rates. There were going to be harsh changes to rules that were applicable to grantor trusts. And there was also going to be an early sunset of the increased unified credit, the estate tax exemption. So all those items are out. The topics that you're seeing now are currently in. So why don't we get started with the topics? So first one up is employee retention tax credit, and Amy, please take over.
Sure. So the employee retention tax credit, the change to the employee retention tax credit actually already occurred. It's not part of the Build Back Better Act. It was part of the Infrastructure Investment and Jobs Act that did pass in November of 2021. It was signed in November of 2021. So I'm going to give a little bit of background first about employee retention tax credit, and then I will tell you what the change was that was made in the most recent bill. So employee retention tax credit was created under the CARES Act of 2020, and it allows for a refundable credit for employers with less than a certain number of employees who were either the employer was shut down by government mandate, or they had a 50% reduction in gross receipts in any quarter in 2020 as compared to the same quarter in 2019. For 2020 purposes, the maximum credit was $5,000, up to $5,000 per employee. Initially, when this first came out, an employer was not eligible for ERTC if they also had a PPP loan. So for a lot of clients, a lot of taxpayers, the PPP loan was a better deal at the time. And so ERTC wasn't really relevant. But the Consolidated Appropriations Act of 2020 changed the rules to allow employers who had PPP loans to also be eligible for ERTC. You just couldn't use the same wages. So this act also made other substantial changes to ERTC, making it much more lucrative, including extending ERTC through the end of 2021, which we're going to get back to in a minute. They changed the eligibility for 2021 to be a 20% reduction in gross receipts in any particular quarter, as opposed to 50% reduction, which was required in 2020. It changed the eligibility in 2021 to include employers with less than 500 employees, whereas it was 100 employees the year before. And it also changed the credit amount to a maximum of $7,000 per employee per quarter. So as you can see, the ERTC was much more lucrative in 2021 than it was in 2020. And a taxpayer who now determines that they are eligible or were eligible for this credit can go back and amend prior quarter payroll tax returns to claim the credit and get the refund if they subsequently determine that they are eligible. So back to the Infrastructure Investment and Jobs Act, which was signed, as I said, November 15th, it ended the ERTC program for most taxpayers early, retroactively to September 30th of 2021 instead of December 31st. There's a small exception for certain recovery startup businesses, but for most taxpayers, it does end or did end September 30th. Since the program was terminated retroactively, as I said, the bill was signed November 15th, but the effective date was September 30th. Some taxpayers who thought they were going to be eligible had either reduced their payroll tax deposits or claimed an advance credit for the fourth quarter of 2021 for their October and November payroll, and now comes to find out that they're not eligible. So the IRS recently provided a notice regarding penalty relief for late tax payments for those taxpayers who were expecting to get the ERTC for the fourth quarter. And it basically says that they're not going to assess penalty if the taxpayers get these tax deposits paid or repaid by the end of the year. I want to stress that if a taxpayer has not claimed ERTC yet, but determines now or even next year or at a later date that they were eligible for one or more than one quarter in 2020 or 2021, it's not too late to go back and amend the prior quarter payroll tax returns to claim the credit. So even though the program is technically ended on September 30th, you can still go back and file for prior quarters. If anybody needs help or has any questions, you can feel free to contact us to help determine your eligibility or help calculating the amount of your credit.
Thank you, Amy. The other topic that is also that tax provision that was included in the Infrastructure Investment and Jobs Act is on the cryptocurrency and reporting. And with that, John Campbell will talk about it.
Yes, thank you, Mitch. And thank you everyone for joining us today. So as Mitch mentioned, the other piece of this had to do with cryptocurrency. This has been a hotbed item for the IRS for several years now. That there's no real set reporting requirements for a lot of the transactions that occur within cryptocurrency. And many of you may have already recognized that the IRS even started putting a little yes/no question on all of your individual returns, asking if you own or otherwise are trading with cryptocurrencies, because they're trying to get a handle on to see how many taxpayers this may be affecting, and come up with certain rules in order to help administer this process for them to capture all the revenue out there. And the Infrastructure Investment and Jobs Act, the IIJA, more or less gave the IRS the teeth that they were looking for in order to be able to do this. So it creates a reporting requirement that says that all cryptocurrency transactions, and when we say cryptocurrency, we're talking things like Bitcoin is predominantly the one you hear of, but there's many others. But all of these cryptocurrency transactions will now be treated in the same manner as stocks and securities. The act did not opine on exactly what form that needs to take, only that this reporting requirement is going to go into place. And so the requirement itself will go into place for reports that are due after December 31st of 2023. So as you can tell, that's basically 2 years from now when the reports would be due. So if this gives the IRS sufficient time to put together a plan on how they may want to incorporate this potentially with existing 1099 structures, or maybe even utilize new 1099 forms that would be able to provide the information that is necessary for taxpayers to file for these things. But in the meantime, it's the reporting requirement, because it's 2 years from now, still means that taxpayers are going to have or may still have some issues reporting their sales. So you have to be careful in how you go about utilizing those. And I want to also stress that the rule is on the reporting requirement for filings due after December 31st of 2023. So that means your transactions in 2023 would be reported in reports due in 2024. So again, this wouldn't be something for another couple of years. And the other nice thing about this was also one of the few, this is one of the only revenue drivers that was added to the rule. The IIJA did a lot to just reappropriate a lot of funds, but this is one of the few where they were hoping that putting this in place will actually drive revenue because of increased reporting requirements from others. So, and with that, I'll go give it back to Mitch.
Yes, thank you. So I'm going to talk about the Build Back Better update on the Senate changes to the House legislation and the passage timeline on the final bill. So during recent months, Congress has had to consider two separate yet somewhat similar bills, including the Infrastructure Investment and Jobs Act that both Amy and John spoke about, that was signed into the law on November 15th. It was a $1 trillion bipartisan bill to fix roads, bridges, and expand broadband internet with very few tax provisions. And the two are the ones that we just covered, ERC and cryptocurrency. The second bill, the Build Back Better Act, was passed by the House on November 19th. Then it was sent to the Senate for its consideration. The bill contains non-traditional social, climate policy, and educational infrastructure spending, along with many tax provisions, which are the topics of today. The legislation is for $1.75 trillion in spending over 10 years. This falls short of the $3.5 trillion proposal President Biden announced back in August. Since November 15th, Congress has been busy with additional legislative bills, including a further extension to February 18th, 2022, on the Government Funding Act to avoid a government shutdown, an increase to the debt limit by $2.5 trillion, and a $700 billion defense bill. On December 11th, Senate Finance Committee Chair Ron Wyden released its version of the Build Back Better Act. It includes provisions on paid leave, healthcare, climate policy, higher education, and trade, along with many tax provisions. The committee modified the House's version to include technical and policy changes, as well as modifications to ensure compliance with Senate budget reconciliation bills. There are differences with some of the House bill tax provisions that will be covered today by my colleagues. The final Senate version will change before it comes to a vote, because this is just the jurisdiction falls to the Senate Finance Committee to put out a draft version of the Senate, but it will be debated, and we expect further changes before a final bill is voted on. Currently, because of a slowdown in the Senate negotiations, and I'm sure everyone has read about that, there is no certainty the bill will pass in 2021. It may be delayed even further, as Senate Democrats may turn its attention to a voting rights bill in the coming weeks. This may intensify political pressures impacting the Build Back Better Act. So stay tuned, as we don't know at this point whether the bill will be signed before Christmas, which is fast approaching, or will be kicked into next year and delayed further because of the voting rights bill discussions. So with that, I'm going to introduce Jim Marota, who will talk about the SALT deduction cap.
Thank you, Mitch. The original House bill, would increase the limitation on the current $10,000 deduction to $80,000 and $40,000 for married taxpayers filing separately or for trusts. It would extend the limitation through 2031. Under the current annual SALT deduction cap, so it would go until 2030, and then in 2031 it would reduce back to $10,000, and then in 2032 the limitation would totally expire. Now, if you recall, the Tax Jobs Act had the $10,000, but it was going to expire a lot sooner than this current bill. So what that means is the Build Back Better plan has a 7-year limitation, which is longer than the Bill for Jobs Tax Act. And the SALT deduction was talked about between 2 senators that wanted to keep the $10,000 limit, but they were willing to do it only for higher income households, which was between $400,000 and $550,000. Other than that, if you have income lower than that, then they said there shouldn't be any limitation. But the House agreed, and the current bill is the limitation is $80,000 up to 2030. Now, the Senate Finance Committee came out a few days ago stating that they did not want a limitation, and so that is to be determined. But that is not what the full Senate hasn't talked about this yet, and this is still being a pretty hot topic in that it's going to be effective as of 2030, as of 2021. So it would be effective as of 1/1/2021. So, this really affects how people might file their tax returns for 2021, and the filing, as we know, the filing would be until April of 2022. So with that, that is the latest update for the SALT deduction.
Okay, thank you. So Amy's going to cover the next 2 topics, which are on expanded child tax credit and the premium tax credit. Amy?
Thanks, Mitch. So the expanded child tax credit, again, a little bit of history here. In early 2021, the American Rescue Plan expanded the child tax credit for 2021 only, so that each child would get a maximum credit. Instead of $2,000, it was increased to $3,000 for children aged 6 to 17 and $3,600 for children under 6. They also made it refundable, which was a pretty big deal because families with low or no income weren't getting the credit because they didn't have any tax liability to be able to use the credit. So now it's a refundable credit, meaning even if you don't have the tax liability, you can get that money. It also provided for advance payments from July 2021 through December of 2021, which was half the year. And then the other half of the credit would be claimed when you file your 2021 tax return. Again, these provisions were for 2021 only. The House version of the Build Back Better Act would extend these provisions, the increased amount. It would extend that until throughout 2022, including the advance payments. So taxpayers eligible for this would get 1/12 of the amount of the credit each month in their bank account. And it also would make the refundability feature permanent. So even if the amount goes back to 2000 after 2022, the refundability feature would remain. There are, of course, phase outs for this, but the expanded increased credit phase outs are lower than the phase outs for the original $2,000 amount. So if your income is higher, you may still be able to get the $2,000 amount, even if you can't get the expanded amount. Lastly, there has been a question proposed to the Congressional Budget Office about how much would be added to the deficit if they made all of this permanent. And the answer was something like $1.4 trillion over the next 10 years. So I don't know where they're going with this. I don't know what's going to end up in the final bill, but it's a lot of money and we'll see what happens. The second topic is the expanded premium tax credit. And that again was developed with the Affordable Care Act and provides an advance credit against health insurance premiums that are purchased on the health insurance marketplace for lower income taxpayers. So basically it makes healthcare affordable for those below a certain percentage of the federal poverty line. If a taxpayer was eligible for affordable, and it's defined, affordable was defined as 9.83% of their annual income. If they were eligible for affordable employer coverage, they would not be eligible for a premium tax credit. So in 2021, the American Rescue Plan enhanced the amount of potential credit premium just for 2021 and 2022 by expanding the amount of taxpayers who were eligible and decreasing the percentage to 8.5% instead of 9.83%. That's the percentage of your annual income that you can spend on premiums and still be considered affordable. And that eliminated or reduced the premiums for millions of marketplace enrollees. Build Back Better plan would extend those provisions through 2025, so another 3 years. It also excludes a portion of the lump sum Social Security benefits, if anybody gets those, and it excludes the first $3,500 of income of dependents when determining your household income for purposes of the credit. So it just makes it a little bit easier to obtain the credit or more of a credit for low income families. Mitch?
Thanks, Amy. Jim will cover the green energy incentives. Jim? Jim, you're muted.
I apologize, Mitch.
It's
So
okay.
most of these energy incentives are already in place, but from time to time, there's always, they always expire. They're always saying, within a few years they expire, but these were extended either through 2031 or 2033. And then there are also new incentives that would be effective after December 31st, 2021. So the bill extends the production tax credit, and the incentive for solar and wind energy is increased. I believe it's 26% right now. I believe they're toying with a percentage increase with that, but they say they're looking to increase that. Taxpayers would be eligible for various green energy and energy efficient incentives under the bill. The bill extends the non-business energy property credit that's placed in service before the end of 2031. The bill would extend the 25D credit for residential energy efficiency property through 2033, which is set to expire in 2020. I'm sorry, through 2033, and it's set to expire at 2023, and would be a refundable credit for years after 2023. The qualified battery storage technology expenditures would be eligible for the credit, and new energy efficient homes will be extended through 2031 and be increased. The bill also extends qualified advanced energy property through 2031 and provides an new investment tax credit up to 25% for advanced and manufacturing facilities. The bill also creates a credit for the production of solar, wafers, cells, and modules and wind blades. Bill provides various other green energy production tax incentives, including nuclear power production credit and the credit for production of clean hydrogen. The credit also creates an emissions-based incentive for electricity generating facilities. And the bill creates a technology-neutral tax for domestic production of clean fuels. Within the green energy incentives, there's also potential new rules for the electronic vehicle tax credits. So the bill provides a provides a refundable income tax credit of up to $8,500 for electric vehicles. The cap is for vans, SUVs, and trucks. There's an $80,000 cap. So if you buy an SUV and it's over $80,000, it wouldn't qualify in this instance. And then for other vehicles, other than those I just said, it's $55,000. The bill would also provide a $7,500 credit for 2- or 3-wheeled electric vehicles. The credit would be phased out for taxpayers with AGI over $500,000 for married filing jointly, or $250,000 for taxpayers. That's a big difference than what we have right now. And there would be a smaller credit for qualifying used vehicles as well. And there would be credit for if you decided to buy a new electronic bicycle. The bill would provide a credit for qualified commercial electronic vehicles as well. The credit would equal 30% of the basis of electronic vehicles, or 15% for a hybrid vehicle. The bill also extends the credit for the production of qualified fuel cell motor vehicles and the alternative fuel refueling property credit through 2031. If you recall, the Jobs Cuts Act disallowed the commuting benefits for bicyclists. Now this bill brings that back in. If you recall, it previously was $20 a month. Now it's an $81 credit a month that they're offering. Again, the Senate has to go through all these, and these might change, but as of now, these are all the incentives in the bill. Mitch?
Yes, I was just looking at the Q&A, and one of the questions was about the salt cap, and what is the salt cap? So Amy, you want to answer? So tell everyone, what is that salt cap for those who may not know? We just it's not something you would find in the kitchen, right? So why don't you go ahead and share?
Yeah, I did answer in the chat, but the SALT is state and local taxes. And that includes real estate taxes and state and local income taxes. And currently the amount of state and local taxes that you can deduct as part of your itemized deductions is $10,000 per year. That was put in place a couple of years ago. And any excess deductions are lost. So this proposed House bill, as Jim said, would increase that to 80,000 if that's in fact what they end up passing.
Okay, thank you. Okay, so the next topic is high income surcharge, and Rebecca will be speaking about that.
Yes, thank you. The high income surcharge, I think this is one of the more talked about pieces of this proposed legislation. I've seen it talked about in the news. Some of you may have heard something about it already. This is basically a 5% surcharge on AGI over $10 million. The 5% surcharge, it's basically an additional 5% tax. It's going to be on top of your regular income tax, your self-employment tax, your net investment income tax, AMT, whatever other taxes. This is in addition to that. So 5% of your AGI over 10 million. So if your AGI is $11 million, you're going to pay 5% of that 1 million excess over the 10 million. Then on top of that surcharge, there's a whole additional 3% surcharge on AGI over 25 million. So you would be paying the 5% plus the 3%, so 8% of whatever's over 25 million. A lot of people hear these big numbers, that's 10 million and 25 million, and they think, okay, my income is nowhere near close to that. I don't have to worry about this. But you have to be careful because there are much, much lower limits for trusts. This applies, these surcharges do apply to trusts. That 5% surcharge starts at just for 200,000 of AGI for non-grantor trusts and estates. That's not that high. We see trusts all the time that have 200,000 plus. The additional 3% surcharge starts at anything over 500,000 for trusts and estates. So if you have a trust or an estate, even if you think you're not anywhere near the 10 or 25 million, you still need to watch this part of this proposed legislation. And when we're talking about these limits, the 10 million, the 25 million, this is AGI. This is not your taxable income. Your AGI is like before your itemized deductions. So charitable donations, for example, are not going to help you. If you think you're right at the threshold for a year and you want to get your AGI down, so you're not subject to this, and you think, okay, I'll just, write an extra $100,000 check to charity, that's not going to help you. You can still give the money to charity, but you're still going to have to pay this tax. This would apply, the way this is written currently, it's going to apply for years starting after 12/31/21, which is in 2 weeks, so next year. So if this does pass, we're going to start talking about this and looking at this right now. I know that it would be nice to know for planning purposes whether this is in play or not. It's hard to make decisions without knowing, but here we are. So I will turn it back over to Mitch to go on to the next topic.
Okay. So John is going to cover the next three topics, which are net investment income tax, the limitation on business interest to partnerships and S corporations, and excess business losses. John?
Thank you, Mitch. So the net investment income tax is something that we've been dealing with for quite some time now. The 3.8% tax that's been, I think it's been since 2013, that's been used to help fund some of the expenditures from the Affordable Care Act. And one of the interesting provisions that had come out of that was a delineation for what constituted investment income, and specifically with regard to pass-through entities, so partnerships or S corporations. They determined that if a taxpayer participated to a sufficient extent in an activity that was from the partnership or the S corporation activity, that they would not be subject to that net investment income tax. So because that would be deemed more to be like you've just made an investment, as opposed to that you're actually running or doing anything for business. The Build Back Better Act would, if as it's currently formed, would remove this exception for participation to all businesses that pass through based on a taxpayer's adjusted gross income number. So for single or other most tax filers, that threshold will be $400,000, and for married filing jointly, that threshold is $500,000. So that would mean that for those of you who may be earning a decent amount of money from a business that you're working in, there is a potential that income, if it's over those thresholds, will now be subject to the 3.8% tax, where it previously had not been. The exception to this rule has to do if the income is subject to self-employment taxes, then I guess it's deemed to have risen to a level that that as it's earned, it's not investment, and so that you would not have to worry about it there. But that would be the only exception once you clear those adjusted gross income thresholds. And this would be in effect as of January 1st, 2022. So for tax years that begin on that on 2022, you will, if you hit those thresholds and you have sufficient pass-through income, it's going to that will kick in. So you definitely want to make sure that you're aware of that going into the following year. So the next piece of that came out from the BBA, or the Build Back Better Act, as proposed, has to do with a limitation on business interest expense. So the Tax Cuts and Jobs Act of 2017 instituted these additional rules on limitations for interest expense. And they more or less come up with a formula that says 30% of your income based on this particular formula would be subject to, or be allowable as a deduction. And anything over that would be suspended until such time that you would be eligible to take it because you, say, have less interest expense or more income in a future year. As the laws currently stated, these limitations are applied at the business level. So if you own a partnership, that would be subject to the limitations. The calculations are done at the partnership level, and then the information would be given to the partners for them to then further calculate anything that may pertain to them. And with S corporations and shareholders, it's also done at the S corporation level, but all of the suspended items would stay within the S corporation. The proposed rules on this would change that, again, effective for years beginning January 1st, 2022. This interest expense limitation would no longer be calculated at the entity level, but rather would be calculated at the individual taxpayer level. So the big piece of this would mean that an individual taxpayer may have multiple different partnerships and S corporations that flow onto their return. And now they're going to have to combine all of the various sources to come up with this one-time calculation that may produce an even further or greater limitation on their interest expense. So again, something else to be concerned about if the bill passed is just to make sure that you're aware of this planning, for planning purposes going forward. The last thing that I'm going to cover with regard to these some of these business changes has to do with the excess business loss. This is another provision that was put in place from the Tax Cuts and Job Act that, as many of you may be aware, it caused limitations on business income that passes through from partnerships and S corporations that would produce a net operating loss. In the past, the net operating loss would be allowed to offset all of your other income to the extent you have other income. And taxpayers even had the ability to carry those losses back to prior years or elect to carry them forward. The Tax Cuts and Job Act took away the ability to carry them back, but the CARES Act of 2020 temporarily suspended that piece and put the old rules back in place. So many of you may have had a similar experience, especially with your PPP loans or your Paycheck Protection Program loans, may have caused you to have some tax losses and gave you some opportunities to once again carry back your NOLs or have them unrestricted. But the provision that's put in place now would also, the provision that's proposed in the Build Back Better Act would take away the temporary status that this had. This was set to expire in 2026, and this would now make it permanent. So this would not be something that taxpayers would be looking for only the next few years, but rather indefinitely. And just to follow this through, the excess business loss limitation means that that taxpayers would not be able to take more than $250,000 of business losses unless they're married filing jointly. Then the number would be $500,000, regardless of how much other income they may have. And any additional losses they incurred in that year would not be eligible to be carried back, but rather be required to be carried forward indefinitely, or would then be subject to future limitations based on how much income you have in those years. So it is a potential that the excess business loss will create a situation where taxpayers would not be able to fully utilize the loss even in the following year, depending on their situation. So with that, I will give it back to Mitch.
Thanks, John, for those covering those three business tax provisions. Next up is Rebecca. Rebecca is going to talk about the small business stock and high income taxpayers, and then move on to the retirement plan provisions.
Okay, thank you. So the small business stock, currently there's been rules for years where individuals that hold what they call qualified small business stock, there's all these rules. I'm not going to go into them today, but if you hold certain stock that meets the requirements, if you hold it for more than 5 years and then you sell it, you can exclude all or a part of the gain. And whether it's all of the gain or 75% or 50 or 60%, it depends on when you acquired the stock. There's specific dates that if your acquisition fell in between specific dates, you fall into those different categories of how much you can exclude from that gain. It's been a really favorable tax provision for many taxpayers. A lot of people have saved a lot of money doing this. The proposed legislation, what it changes is that it removes that 100% and that 75% exclusion category. So for taxpayers over 400,000, taxpayers under 400,000 of AGI still have the option, if they acquired that stock on the right date, they still have the option to exclude 100% or 75%. For taxpayers over the AGI of 400,000, there's still the 50 and 60% exclusion categories that those still exist, but they just apply to less people. There's less people. You would have had to acquire that stock way back, and there's just less people that still have held on to it for that long, but it's still out there. It would also remove the 175% exclusion categories for all trusts and estates. Trusts and individuals are both able to take advantage of these rules. The one thing to keep in mind about this provision is a little bit retroactive the way it's written. It would apply to sales after September 13, 2021, so about 3 months ago. So if you had some small corporation stock that you thought qualified as this qualified small business stock, and you disposed of it, say in October, and you had a gain on it, and you were counting on being able to exclude that gain, if this passes, you may be out of luck. So that's unfortunate for some people. I'm going to continue on to the next topic, which is retirement plans. Retirement plans were a big feature of this proposed legislation. There's several changes that this legislation would make if this passes. One of the big things, if you have retirement accounts that are over $10 million in balance, this legislation would prevent further retirement contributions to the account. That's only for people who are over 450,000 of AGI. But if you have 10 million in retirement accounts, it's not a stretch to think that your income would be that high. This restriction on additional contributions would not go into effect until after 12/31/2028. So basically 2029. So 8 years from now. So there's plenty of time to plan for that. The other thing it would do, it's kind of tied it, that would also go into effect on that same date for 2029. Large retirement accounts, again, over 10 million, the RMDs would increase greatly until you get below that $10 million threshold. The RMD formulas are always complex. I'm not going to go into them, but in the past, they've always been tied to your age and your life expectancy, not really the balance in your account. So this would change. This is the first time it would really include the actual balance in your account in that calculation. Also, Roth IRA owners have never had to worry about RMDs before. RMDs have always been for the traditional accounts. But these large RMD requirements for these large retirement plans over 10 million would also apply to Roths. Again, does not apply until 2029, so plenty of time to plan for this if this does pass. One of the other big things that this legislation would do, is eliminate the ability to make Roth conversions. Again, this is just, everything I've mentioned here is for high income taxpayers, and they're defining that as over 450,000 for joint or 400,000 for single. I think those are inflation adjusted numbers, but be somewhere around there. So if your AGI is over that, you would not be able to convert your balances in traditional accounts over to Roth accounts. That would take effect a couple of years later. That would take effect in 2032. So basically 10 years from now. Again, plenty of time to plan for that. One of the biggest things that this legislation is doing, or is proposing to do, is to completely eliminate the ability to make a backdoor Roth conversion. For those of you not familiar with that term, backdoor Roth is when your income is too high to make a regular Roth contribution. There's always been this loophole in the law that a lot of people take advantage of, where you can make a non-deductible contribution to a traditional IRA instead. And then as soon as that money is in there, you can turn around 10 minutes later and convert it over to a Roth. It has the same effect of basically putting the money in the Roth to begin with. So it's been this big loophole that people take advantage of every day. So this proposed legislation would completely close the ability to use that loophole, and it would close it as of 12/31/21, so 2 weeks from now. So that's something to keep an eye on. And with that, I will turn it back over to Mitch to move on to the next topic.
Thank you, Rebecca. So Jim is going to cover a couple of the C corporation tax provisions on the 15% minimum tax on profits of large corporations and the 1% surcharge on corporate stock buyouts. Jim?
Thank you, Mitch. So the IRS and the government in general has been trying to tax large corporations for a while, trying to figure out how to do it. I guess this is their way of trying to complete that, complete their thinking here. So this would be as effective December 31st, 2022. So again, time for these large corporations to potentially get around this somehow. But the bill would impose a 15% minimum tax on the profits of corporations that report over $1 billion in profits to shareholders. Any corporation other than an S corporation, a regulated investment company, or a real estate investment trust that for any 3-year period has an average annual adjusted financial statement income over 1 billion. And in the case of corporations with foreign parents, has annual adjusted financial income in excess of 100 million, would pay a 15% tax on its adjusted financial statement income for the year over the amount of its they call it a corporate AMT, foreign tax credit. So basically, there are many deductions to go against this income that they're stating for the adjusted financial statement income, and there's many limitations on that. I won't get into it, but the gist is that the IRS is attempting to tax these large corporations at a minimum fee with no credits. But again, these things do have things that will go against that adjusted financial statement income. But that's to be determined, and we'll see what the Senate comes up with on this. Regarding the 1% surtax on corporate buybacks. So basically, whenever corporations try to buy back the shares of their shareholders, the government is trying to tax them on this. This would be effective after December 31st, 2021. And the bill would impose a tax equal to 1% of the fair market value of any stock of a public corporation when the corporation repurchases its stock during the year. This corporation has to be on an established securities market. And this is a proposal similar to what Biden originally planned in his Build Back Better framework, which he called the Stock Buyback Accountability Plan, which was introduced in 9/20/21. Originally, it was he tried to originally he wanted a 2% tax, but the House has agreed to a 1% tax, and we'll see what the Senate comes up with on this as well. Mitch.
Yes, thank you, Jim. I will be covering the last topic, and that is, I'm sorry, I just skipped ahead too far. Rebecca will be covering the next to last topic on IRS issues, more funding for IRS enforcement.
I agree. This is not the most exciting topic, so I don't blame you for skipping over it. One of the things this legislation also does is provide some additional funding for the IRS. The IRS still has whatever is in the normal budget that they get. This is just like additional gravy on top. The biggest piece of this is they're providing an additional $45 billion. That's billion with a B. Available until the end of 2031. So for the next 10 years, they have this $45 billion earmarked to beef up what they call enforcement activities. Enforcement activities are increasing taxpayer audits, hiring new auditors, training those auditors, increasing collection activities, funding for criminal investigations, all that kind of stuff. 45 billion, that's a big number. Compare that, they're spending 45 billion to go after people. They're also budgeting 3 billion to help people. There's a 3 billion here earmarked to help with taxpayer assistance, advocacy, hiring more people to answer the phones. I don't know if any of you have had the misfortune of trying to call the IRS recently. It's not easy to get through. It's not pleasant. It's not fun. So I think they definitely need that 3 billion to hire more people to answer their phones. But that's certainly a lot less than the 45 billion that they're going to spend to go after collecting taxes. There's some money in here for internal administration. There's a $5 billion to modernize technology, which is good. There's a lot of, there's multiple things in here. I won't list them all out for you. But I think it's good. It kind of shows where the priorities are. If this passes, we would expect to see a lot more audit activity, a lot more exams over the next 10 years or so while this funding is available. So I'll turn it back over to you, Mitch.
Yes, and to your point of the frustrations that most of us have been dealing with trying to reach the IRS. Just wanted to let you know that President Biden had signed an executive order, I believe on the 13th, effectively requiring new IRS online tools and services. The mandate is that the Secretary of Treasury shall design and deliver new online tools and services to ease the payment of taxes and provide the option to schedule customer support telephone callbacks. What a concept. The Secretary of the Treasury should consider whether such tools and services might include expanded automatic direct deposit refunds based on prior year returns, tax credit eligibility tools, and expanded electronic filing options. So we will, there didn't provide any specific timing of all that, but I will tell you that any improvement is going to be looked upon as very favorable, especially in dealing with the IRS these days. The last topic, it will be on just a brief update on the estate and gift tax. So for 2022, the gift allowance is going from $15,000 to $16,000 per person, and the estate tax exemption will go from $11.7 million to $12.06 million. Can we go to the next slide? Okay, so we have some time. We've been working through the various questions that have been posed. I do have a few others, and we have some times to get to some of the questions live for our panelists. So I'm going to start with Amy. So Amy, do you have any suggestions on how best to determine if I qualify for ERC, employee retained tax credit?
Sure. So the first step to determine if you qualify would be, if you're shut down by the government for a period, then you're going to qualify for just that period. But the bigger question might be what your gross receipts were by quarter for 2019, for 2020, for 2021. So that's normally where we start. If you put together a list of your gross receipts by quarter, and gross receipts are calculated on how you keep your books. So if you're a cash basis taxpayer, we would consider cash basis tax receipts. If you have a GAAP audit statement and you are accrual basis, then we would consider accrual basis receipts. So if you can put together a list of the gross receipts by quarter for all of 2019, 2020, and 2021, we can certainly look at that and help you determine which quarters you may be eligible in.
Okay, thank you. The next question I have is for John. John, what advice can you provide to assist in properly reporting my cryptocurrency transactions for 2021? I just want to clarify, that's not my cryptocurrency transactions, but somebody else's.
You're in a more of a wait and hold position. I understand. No, that's a really good question. But until the reporting goes into place, it's been more of this Wild West kind of mentality, in the sense that everyone was just responsible for looking into this on their own. And another thing that's a little interesting about cryptocurrencies, it doesn't quite follow the exact rules for how you trade individual lots or coins, and that it actually is in FIFO order. And so that can become much more cumbersome for taxpayers to keep track of exactly when they bought what coins, especially when they start the coins potentially are splitting or being traded or in other ways exchanged for other cryptocurrencies. So there are a lot of online resources that are relatively inexpensive. In some cases, they may be free depending on the volume of your transactions. But the ones I've seen clients use a lot are cointracker.io and bitcoin.tax. These are two different websites that can offer a system where you're able to upload the information on all the sales from your cryptocurrency by downloading them from your wallet, or which is where you are predominantly your cryptocurrencies, and then they will turn it into information that will allow you to report your tax filings. And this is especially can be useful if the Build Back Better Act passes, because there's one thing we didn't really cover in that for BBBA, in that they also want to change the wash sale loss rules so that cryptocurrency would be included with that. But that provision will go into effect, much like many of the others, on 1/1/2022. So coupling back to what we were talking about earlier, there are, the reporting requirements will mean that taxpayers will get some form of 1099 or other report that would normally keep that in place, such as, when you have stock sales, it'll let you know what your wash sale losses are. But for 2022, that would mean taxpayers are responsible for making sure they know the wash sale rules. And so the hope is that some of these websites that are out there that can provide the information for you may be able to calculate those wash sale losses. But if not, taxpayers need to be aware of that to make sure they're looking for any kind of wash sale issues they may run into.
Thanks for answering that, John. Jim, so we spoke about the SALT cap. Somebody asked, why is the SALT cap really such a hot topic? Any insight is appreciated.
Sure, Mitch. It's such a hot topic, especially in this area, because real estate taxes are super high compared to other places in the United States. And real estate taxes alone for most individual taxpayers get you to that $10,000 limit, not including, and then when you include your wage state income taxes from, your W-2 jobs, that easily, also that alone can get you to the $10,000 limit. So unfortunately, the last couple of years, these individuals, taxpayers, are losing a lot of deductions because it's been limited to $10,000. But they're, at least for this BBB provision, at least it'll give a lot of people a little relief, where you get the $80,000 and maybe you're a little bit under the threshold, or maybe a little over the threshold, but at least you're $70,000 better in deductions. Hopefully that answers your question.
Sure. So Rebecca, I have a couple questions for you. One is, if you donate appreciated assets to a charity, can you deduct the donation to a donor advised fund, and with what limits? And two, if you donate directly to the charity, what are the deduction limits for appreciated assets? Also, if you donate more than the limit, can you take a deduction in future years?
Is this like a pop quiz?
I think it's a pop quiz, and it's a three-parter. So
That's a long question.
Okay.
The donor advised fund, I believe you can do appreciated assets. I'd have to look up the rules.
Fair.
I think you're at 20. I think it's a 20% AGI. I know if it's a private foundation, it's 20%. I would imagine donor advised fund probably is too. We can certainly look up those rules after and confirm that.
Okay.
What was I think I missed
it. What are the deduction limits for the appreciate? You covered that. You'll have to get back. And if you donate more than the limit, can you take a deduction if it does it? Is there a carryover?
There is a carry forward for charitable contributions. I think currently it's at 5 years.
Right. Okay. So we'll get some clarity on that, and we'll answer that in more specifically. But I have another question that's relating to the topic on retirement plan. So is it still advantageous to convert a IRA to a Roth before the end of the year? I've been told not to consider it if I don't have the cash outside the IRA. And again, I'm not thinking about doing this IRA conversion, but somebody else is, and they
Maybe
would
you
like to
should
know.
think about it.
I should think about it, and I will.
Yeah, it can definitely still be advantageous to convert to a Roth before year end if you're able to. Roth accounts are great. They let your money grow tax-free until your retirement, just like any other retirement account, you have tax-free growth. But then when you take out those funds to use, they're not taxed. You get to take them out tax-free. That's the real advantage of a Roth, as opposed to distributions from your traditional accounts, which you do have to pay tax on when you take them out. So a Roth is a great way to grow retirement funds. They're very desirable. They're very popular. The thing is, when you convert, if you're converting funds from a traditional to a Roth account, which is what he's asking about, you have to pay the tax on those funds when you convert. So if you did a conversion before year end, on April 15 of 2022, you're going to have to pay that tax on the conversion with your tax return. You want to make sure that you have the cash to pay the tax on that conversion outside of the conversion, like out of pocket. You don't want to use the conversion funds to pay your tax. If you do that, you're taking more money, you're taking money out of this tax protected account and not allowing it to go tax free. It's not a good idea. What we really recommend that people do if they're looking at a conversion is back into the amount of the conversion, figure out how much cash you have to spend on tax, then contact your accountant, which is hopefully us. Let us help you calculate your current year tax rate, et cetera, and back into, if you want to spend X amount of tax, how much could you convert to spend that amount? Obviously, with having this legislation in flux, it makes it a tiny bit harder to plan things, but you certainly do the best you can. But yes, Roth IRA conversions, if you have the funds to pay the tax, are definitely a great idea before the end of the year.
Okay. Well, Rebecca, you definitely have the spotlight right now. You, I believe, may have answered a earlier question, and I think you may mention that you might want to share that with everyone else.
Yeah, so several Q&As were coming in while we were doing the presentation, and we made our best attempt to try to type in brief answers. But somebody asked something that I just wanted to clarify. Earlier, I talked about the surtax. So that's the additional 5%, and then even the additional 3% for individuals and trusts. And somebody was asking, if you sell stocks, wouldn't those be taxed as capital gains? And they absolutely would. This surcharge is on top of all your other tax. You're still paying your regular income tax. You're still paying capital gains on capital gain sales. You're paying your regular income tax at whatever your 37% or 30, whatever your tax bracket is on your wages, your interest, your dividends, everything. This surcharge has nothing to do with that. It doesn't replace that. This is in addition. It's a whole other tax. Basically, it happens to get paid on your tax return with your other taxes, but you still have to pay your same regular tax and capital gains tax and AMT tax and self-employment tax in addition to this. So I hope that clarifies for everyone.
Clarified it for me, so I certainly appreciate it. As you see now, the slide shows our panelists today. I want to thank my colleagues for their participation, covering the many topics and taking the time to answer all of your questions. Their names and their email addresses are there so that you can, follow up if you have any questions further. We would certainly be happy to answer any of your questions, after this webinar is complete. Today we covered topics that were in the Infrastructure Investment and Jobs Act that was signed into law on November 15th, and the Build Back Better Act, which is still in process, As we stated earlier, the House has already approved it, and the Senate is grappling with it, and it doesn't appear that it will become law at the end of the year, but you never know. We can get off this webinar and there is a consensus with the Senate, but you all have to stay tuned. And so to stay in tune, a copy of the recording will be posted on our ISDANER social media and our website. Visit, as the slide says, visit our website for the latest updates on our website, and it gives you that. I want to wish you all a happy holiday season and a happy and prosperous new year. Have a great day. Thank you.